Hi, this lecture is about the LLQP exam, life insurance, and it is useful for people who are going to be taking the life insurance module for the LLQP exam in Canada. However, everybody has some sort of need for life insurance. If you're considering buying life insurance, if you're considering understanding about it, it's very useful for you. And also, you may already have some life insurance products with you, and in order to understand your policies, this is a very useful lecture indeed. So hopefully you will be seeing the benefit of this. First of all, the introduction to life insurance. What are the purpose? Of course, obviously, somebody dies and the family members or somebody else or another organization will receive the money. So there's the risk of death. That is, if the person dies, there is going to be some possible financial impact. So those are the main, of course, reasons for life insurance. And there are different needs. Most people here in Canada, US, other countries have mortgage, have a loan on their home, and that's a large amount of loan, usually 300, 400, 500, 800,000, $1 million possible. So, and that is a temporary need. So as you can see on the left side, that is one of the main temporary needs, that a mortgage will be paid off with the use of life insurance. Second is for children. So children, you want to provide your children a decent amount of money for education. In case the main earner passes away, then there's a critical issue that the children may not be able to complete their studies. So for that purpose, this is also useful for ensuring that if a person dies, a sizable amount of money, maybe 50,000, 100,000, will go into the education fund for the children. The third thing is term loan. So if there's a term loan, that is a loan which is for a certain time period, for example, for a car, it's for 5 years loan. In order to make sure that if the person dies, the loan is not going to be called back by the lender, for that purpose, then life insurance is also useful. So these are three main temporary needs, and for this we use what is called term life insurance. And term life insurance has a start date and an end date, and it could be for 5 year, 10 year, 20 years. It could also be longer. Permanent life insurance, there's three types, as you see on the right side. There is whole life, there's UL, and there is T100. The whole life has fixed or adjustable premium, which means obviously you can pay the same amount or it could be varying. It has some cash surrender value, which we'll talk about later, but basically it means that if you cancel the policy, you may get some money back. It has an investment portion in it also. In the UL, the universal life, which we'll talk about in more detail, but just basic idea is your premium is flexible. You can pay a minimum amount, you can pay more, you can pay less. And so there is investment portion in it also. And then there's the T100, which has a fixed premium, and there's no cash surrender value usually. So for example, just remember there's no cash value. If you cancel the T100, you don't get anything back. So these are permanent life insurance policies. What is the purpose? That is, if you have anybody at home who is going to be passing away and then their income, it will affect the family. So to replace the lost income, that is one obvious reason. Loss of a homemaker. Anybody, one of the spouses staying home is also going to be a value. That is, if they pass away, then you have to get a replacement to take care of the family, of the home, etc. So there will be a cost for that. Debt repayment. There may be permanent debt, which is going to be revolving type of debt, which is like credit card or line of credit. So that also will be paid off. And it is a fact of life that income taxes are due here in Canada and in most countries other also. When a person dies, the final tax return of the person is filed, and number one is the salary for the year that has to be taxed. That is whatever the person earned in the last year of life. Secondly, any capital gain tax. By capital gain tax, we mean if you buy something cheap and you sell it at a higher price, it's called a capital gain. If you bought any non-registered security like a stock, a mutual fund, a bond, any other type of investment which you buy low and you sell high, there is a capital gain. And that capital gain, if the person dies, it will be taxed because it is the person, it is called a deemed disposition. It means that for tax purposes, the government considers that the person has sold his investments or her investments. If a person has a secondary cottage or a rental property, for that purpose also, they will be there will be a capital gain tax evaluated. Person bought the property for $100,000 and now it's worth $500,000 when they died. So there's a $400,000 capital gain, and half of it, that is $200,000, will be taxed at the marginal tax rate of the person on death. So that is also second reason. And then the third is RSP. Anybody has retirement savings plans, that is for retirement, any money which is set aside, it reduces your taxable income in the year that you put it in. But if the person dies before retirement, all that money, whatever is in it, will be taxed by the government because that money was never taxed. It's like they had the salary, they had the income, but they never paid taxes on it. And so now it will be taxed. So for these reasons, everybody will have some tax due on death. And that is one of the main reasons why almost everybody does need permanent life insurance. And also, other reason is estate creation and legacy and inheritance. So estate creation is somebody does not have any savings and they want to leave money for their family. So it's useful for them to have life insurance because when the person dies, if they don't have any money available at all, it's beneficial. The family gets 100,000, 200,000. Some money is available there for the family for inheritance. And it's also possible that there is a business and there may be leaving, or another property, there may be leaving a property or a business to one of the child, and the other child, the other sibling, it would be it won't be fair for them if they're not getting anything. So life insurance can help to equal out that inheritance issue also. So it will be an equalization way of calculation for that purpose. And then charitable giving, if a person wants to leave money for the church, for the temple, for a mosque, they can say that they want to leave it for that. And there's different ways we'll talk about, but that is the other purpose. And then the business impact is if you have two partners or three partners in a business, one of them dies, it will affect the business, and the others have to buy out the value of the shares of the other partner. And for this purpose, we will discuss in detail how crisscross arrangement and other types of business life insurance helps out for that purpose. So for all these on the right side, you do need permanent life insurance, and these are the needs. That is the purpose why a person would want to get life insurance. And basically, like many times they ask you this question, what is a type of life insurance in terms of risk management? And basically it is risk transfer. Risk transfer, the last one here, is the purpose of life insurance, that you are transferring your risk to the life insurance company. For risk avoidance, it means that you basically are not undertaking any of that activity. So that is if you are afraid of driving a car, you don't take public transit at all. I'm sorry, you do take public transit, you don't drive the car at all. That is your risk avoidance. For risk reduction means you are careful, you use your seatbelt, you follow the rules. That is a type of risk reduction strategy. Risk retention means that you agree, yes, I can get in an accident, I have the money to fix the car, it's illegal, you have to have insurance. But let's suppose a person does not take insurance and they say, I will cover any cost, whatever happens, I'll see what happens. That's a risk retention strategy, which of course is not a good idea. But anyways, so risk transfer basically transfers the insurance to the other party. Okay, thank you. Next chapter, so that was the first chapter. Second chapter, they start talking about policyholder and life's insured, different types of insurances. So it can be term or permanent. So whether it's a term policy or a permanent policy, the first one is these two are single policies. Single policies mean that there is only one owner. As you can see here, the owner, the person who completes the application and pays the premium, is the owner of the policy. John is the owner of the policy in both cases, so it is a single life insurance. And it is possible he can have a single life insurance with the annuitant as John himself. By annuitant, we mean, think of it, the life insured, that is who is going to die. Who will die for the life insurance money to be paid out? If John will die, then somebody else has to get the money. There is a beneficiary. The beneficiary is who's going to get the death benefit. And it can be revocable or irrevocable. By revocable means you can change that at any time. Usually that is 99%. We usually recommend that. spouses may change for some reason, children, whatever. You want to make changes, you don't have to ask anybody. With irrevocable, you have to get written consent from the beneficiary in order to make any changes. So let's suppose Mary is the beneficiary. So if John dies, then Mary will get the money. And the example there is, of course, for mortgage. Second one is that John, he takes out the policy, he's paying the premium, and the life insured is Mary. In this case, John will get the money. So if Mary dies, his spouse dies, John will get the money, he is the beneficiary. And in this way, he is protecting himself. For example, let's suppose she is at home. So if there's a loss of caregiver, he gets some money on her death. And that is a single life insurance policy. Joint, there's two types of joint. There's joint first to die and joint last to die. Joint first to die is obviously going to be, the owners are going to be both John and Mary. They both do the application, they pay the premium, whoever. And any one of the two spouses dies, the surviving spouse gets the money. And this again can be for the mortgage, for income for the family, other purposes. So that is how the first to die is when one spouse dies, the payment goes out. Joint last to die means that there are again two owners, John and Mary, spouses. If the first spouse dies, there's no payment. So no money goes out to the surviving spouse. Second spouse dies, then the death benefit is paid out, the life insurance is paid out. And usually in this case, the beneficiary will be the children. The children will usually be the beneficiaries in this case. And so this is usually used for taxes due on capital gain, on rental, or on a cottage. So like we talked about, if you bought a property for $20,000 30 years ago and now it's worth $500,000, there is a capital gain. And if you're going to transfer the property to your children, you cannot do that without paying capital gain taxes on it, because it is a rental property or a cottage. It's not your principal residence. Principal residences in Canada are exempt from capital gain. However, any other rental or cottage secondary property is going to be taxed. So anyways, this is the purpose when you would use a last to die policy. Then talking about term insurance, there are three different types of term insurance. One is the level death benefit, which means that basically, very simply, the premium stays the same and the death benefit stays the same. So you're paying maybe $30 a month and your benefit is $250,000. It's for 20 years. So that is a term level death benefit policy. In the case of the decreasing, it's easy to understand also, like when you go to the bank, they will offer you decreasing term insurance. And that is an example where you are paying less. So you are paying the same premium, but the death benefit is decreasing. It's called decreasing death benefit. So as you can see here, the death benefit decreases, the premium stays the same. You pay the same amount. You pay $30 a month, and you're covered for initially 200,000, then 150, then 100, then 50, then 25. So your death benefit will be going down. And this is useful if you are using it for the purpose of a mortgage, because mortgage balance will be decreasing over time. Increasing death benefit is your death benefit increases and the premium increases both. So it's usually this, when is this useful? When like a lawyer or a doctor is just graduating from their college, university, and they are starting out in their career, their need is initially lower, but later on their need would be more. So they are ready to pay more premium later on, and they want more coverage. So this is useful for them in that case. But more common we have here is level death benefit or decreasing death benefit. This is just showing that the premiums, so if you're paying a premium, if you're thinking about getting a 10-year term policy or a 20-year or 30-year, if you are at a younger, I would say like 40, 50-year age, as you can see here, if somebody is, suppose 40 is here, 47.5, the price for a 10-year term and for a 20-year term is not double. It's a little bit more, but it's not double. And same thing for a 30-year term policy. So if you have a term policy, if you're getting the prices, usually this is an average, like giving an idea. But it basically is not going to be like double. It's usually a little more if you're going to get 20. So if you're getting a premium estimate, it's a good idea to see what is the what is the price for a 10-year, a 20-year, and a term, 30-year term. So the premium depends on three things. One is mortality cost. That is, mortality cost is what is the probability of death? What's the chances that somebody of your age, of your health situation, is going to die? And the insurance company has a lot of different tables to look into, and they estimate and calculate that. Then the expenses for the company, they calculate what are the expenses. Of course, the company has expenses for paying the admin fees and the other you can say like commissions and all the other expenses for managing the policies. And females are expected to outlive males, so females have a little bit lower premium. So that is the other concept in case of the term policy. And in this example, also in this question, as you can see, we're talking about Jim and Teresa. They're both 50 years of age, and they both apply for life insurance. And obviously here you can read through the questions, answers, but it is basically going to be that there will be an impact on this, right? So Jim will pay a higher premium because women tend to outlive men. So that is like the, of course, best answer here. For term, so this section, we're all talking about term policies now only. Term policies can be renewable, non-renewable, and or convertible. Renewable means that at the end of the term, so if you have a 10-year policy, at the end, you can extend the policy for the same coverage. If you have a policy for $250,000 for 10 years, you can extend it for another 10 years for the same coverage. And there's two types in that. There's guaranteed rate and there's adjustable. In the guaranteed rate, there's no medical. Upfront, you know right away that, okay, after 10 years, I'm going to be paying this dollar amount. Adjustable, it means the medical is undertaken, and if you have good health, you'll get a lower premium. If your health is bad, you will get a higher premium. So in this case, adjustable is more useful if, of course, the person's health is good. If the person's health is bad, but again, it's not easy to predict. You don't know how your health is going to be after 10 years or 5 years or 20 years. So it depends on the situation, which one is better. Non-renewable simply means there's no renewability option. You have to reapply. If your health is bad, the company may not accept your renewal at all. So if expected health, issues may come along, it's better to get a renewable one with like a guaranteed rate. So there's no medical, regardless of your age, it will be renewed, but of course the premium will be higher. Convertible means that any time in the duration of the term policy, you can convert the term into permanent life insurance, and there's no medical also. So that is a big feature, a very good benefit of a term policy. So this is when you're comparing term policies from different companies, you have to see whether they are renewable or not, whether it's convertible or not. And with convertibility, let's take a look at this example. If the client was 45 years old, that was the original age when the term policy was taken. Now, 10 years has passed, client is now 45 years old. So that is called the attained age. Let's consider that the client had a term 20 policy. And so obviously 10 years have passed in the policy. So there's two options the client can do. One is using the attained age or using original age. And by attained age, we mean that the attained age is 55 years. He is now 55. So 55 is the attained age for the universal life or the whole life, whatever permanent policy they're getting. So the company will calculate, and there's no lump sum premium, only will be higher. Let's suppose it's going to be, for example, $200 a month. So the client is now going to pay $200 a month for a permanent policy, which he converted from his term. So the term 20 will be finishing, and now it's going to be converted to a whole life. The other thing the client can say that please use my original age, which was my original age was 45. So if they use 45, they're going to say, okay, we're going to give you a policy which is taking into consideration your policy is like a 10-year-old UL policy. But for that purpose, the company may say you need to put in some lump sum amount. It could be, suppose, $6,000. So that's, for example, it's been 10 years, and let's suppose he should have put in $600 every year, but he has not. It was a term policy. So in this case, then they may say you need to put in a lump sum amount in order to bring up the cash value, the investment value in the UL policy. And so in this case, the premium is going to be less. The premium could be, let's suppose, $150 a month. So the client is able to pay less money on a monthly basis, but they need to put a lump sum amount down to make the policy up to the par. So this is like giving an idea for term policy. It's like car insurance. You're paying for the policy and you're covered, and that's it. That's simply what a term policy is. There's no investment in it, no nothing extra features. With the UL and with the whole life, you have that extra benefit that you have an investment account, and your investments will go up probably depending on where it is invested. So we'll talk about that more. Hopefully this is more clear, the renewable and the convertible feature. The other thing they talk about is suicide and contestability period. This is both for term and permanent also. So first of all, suicide provision. So of course, never a good idea to do that, but anybody who does that within 2 years of policy issue, there's no death benefit paid out. The company will usually just send a refund of the premiums to the family saying, we're very sorry to hear about that. Here's the money that the client paid us. The policy is canceled, and sorry about everything. And if the client does suicide after 2 years of the policy issue, they will pay 100% of the death benefit. This is like a standard in most all the companies here. So that is like the concept of the suicide clause. Second is incontestability. So this is what we're talking about here is, does the insurance company have the right to investigate the application, what the client wrote? Many times the client fills out an application and the company may not do any tests, any investigation. They'll just issue the policy. If it's a small amount, sometimes 100,000, 250,000, they will just issue the policy. And the company has 2 years from the date of policy issue, that is called, that 2 years called the contestability period. The company can, of course, they will look into the details of the policy, and they will, the application, they can cancel the policy if the application has material misrepresentation. I mean, if the client basically lied on their application or did a fraud, then the company has the right to cancel the policy. After 2 years, it's called the incontestability period. The company can only cancel if they can prove fraud, if they can prove that the client actually did this to take advantage from the company, that it was there's bad intention there. Then only they can cancel it. So this is the concept of the contestability and incontestability period. So the next chapter is about whole life and term 100, but I'm going to pause there and we will continue this discussion in our next section. Okay, thank you very much, and bye for now.